Good morning, everyone. Good morning, Kay.
Good morning, Ryan. Happy whatever FOMC or perhaps ECB day.
What a bonkers morning. I've done nothing today. I had a lot of prep to do for the Fed this morning that I was going to do on the show. It all went out the window within about 10 minutes of sitting down. Yeah, what a bonkers morning. I assume everyone in the room here is aware of what's going on. We've got an impromptu ECB governing council meeting happening right now, due to go on for a couple of hours. That's really got the market in a bit of a tizzy this morning. So I've got very little prep for today. So we're just going to be looking at that and then having a look at the Fed and just covering any other little bits and pieces going on. Just a funny headline amongst the madness today I saw there. You've got on the screen now. A bit of fiscal policy measures from Pakistan. They want people to drink less tea over there because they're a huge importer of tea, and they want people to drink less tea to help keep the economy afloat, because it will bring down the high cost of import bills. They import tea on loan. So there's a bit of a funny fiscal headline for you this morning. Obviously in the UK here we drink a lot of tea. I didn't even manage to get a cuppa before all this ECB stuff hit, so one of the reasons why I'm a bit behind. But that's one of the funny headlines amongst the madness today. So what about this ECB meeting then? The gist from the sources stories that we heard is that they're having a meeting to discuss this market route. What market route, I hear you ask? Well, obviously we know that yields are jumping around the globe, a natural consequence of everyone pretty much hiking across the board. Yields in Europe, yeah, they're up high. You've got Spain, Italy, and Greece, around the 3-4% mark. Compare that to Germany, 1.7%, France, 2.3%. So it's really the widening of the spreads that they're worried about. But is this a market route right now? I wouldn't call it a route. And in fact, given over the last few days' performance, things have pretty much settled down, at least in spread terms. Wow. So now the ECB have announced they've got this meeting to discuss the route. They've put themselves in a bit of a corner because now they've highlighted that they're worried about something, which the market now looks at and thinks, right, well, if they're worried about something, they're having a meeting, they're going to need to tell us something, what they're going to do. And if they don't tell us anything strong, or they don't give us any idea that they're going to got something strong about this, the market's going to spank them for it. So in effect, in one sense, if they don't deliver on this meeting, they're going to get the market route that they're having a meeting about, and it's probably going to be worse. Now, obviously, us, like the rest of the market, have been trying to slice and dice up what they may do. And K-Man in our chat room put up 3 possibilities there, what they could possibly do. We have had another sources piece out saying that this meeting is about potentially using PEP reinvestments as part of this fragmentation tool or scenario they're hoping to avoid, which will be on the lesser side of strong action, should we say, using an already used tool that was supposed to end to prop up yields. I mean, remember, the PEP is for the pandemic, and we're coming out of the pandemic, so to use a tool that's for the pandemic for this situation isn't necessarily viewed in positive terms from the euro perspective. So as Kay mentions there, we saw the euro come down a little bit on that headline, that sources headline. Again, a lot of the market is tying the potential for the ECB to announce a hike here. Maybe they've been shaken up by everything that's going on. Maybe they've had a little whisper from Mr. Powell across the pond as to what he's going to do, and maybe they feel the need that it needs a response. As Kay says there, what a rate hike could be positive for the euro, depending on the size and the note that comes with it. But on the flip side to all of this, the market's sitting here thinking, why is the ECB panicking? And if the market thinks ECB is panicking more than trying to solve a potential problem, you know, that's going to create a different situation in the market's mind. It wants to know what is going on, what's going wrong. There is a couple of other possibilities that this meeting they've called, and I noted it. Maybe there's no action. Maybe it's a lot of hot air waffle, similar to what we've already heard. That will be the conclusion. And yeah, the market's going to again spank them for it because they put themselves in a position now where the market wants to see what the ECB are going to do. I did have a little bit of a off-the-cuff tinfoil hat comment on this as well, that perhaps there's going to be a coordinated effort or coordinated rate hike from central banks, mainly driven by the Fed. If the Fed are going to go hard and high, maybe the others need to play a bit of catch up. And the thing that they all want to protect is financial stability. So if they all coordinate a rate hike, that will bring some short-term noise, but it won't potentially increase the divergence trade, which a lot of this is driving yields and driving FX moves and so on and so forth. So if they all hike, say, a similar amount, that negates the divergence move, and it sends out a strong message that they are all looking to tackle inflation, but all want to protect financial stability. As I say, that's a little bit of a conspiracy thing. It's probably a very low risk, but with everything in markets, you can't rule out anything 100%. So that's the setup for this meeting. We've yet to get the outcome. So I know Kay will be too, but I'm keeping my eyes on the headlines and the news wires at the moment while we do this show, in case anything drops in the meantime. Kay, do you want to add anything to that? Any thoughts as well?
No, basically what I put on there, it's a bit of an open question. I don't think that in a 2-hour meeting they will decide upon a inter-meeting hike. But yeah, if it's only using what's left over of the PEPP and giving it another name for the use to control spreads, it's not going to support euro for long, in my opinion, because using it to control the spreads means that something is wrong. On the other hand, spreads going down mechanically supports the euro, so it could be a bit of a non-event perhaps, but I don't view it as a really longer-term positive tool to use, because it's still injecting money unless they come up with this new tool. And by a new tool, what I mean is that they control purely the spread, which means that they would buy peripherals, but at the same time sell the core, like Germany, Austria, Netherlands, France, perhaps in there as well, and some others. But it's a little bit of a question how they are going to manage it, this thing, because I'm not sure that the Germans would be happy to sponsor the bulk of the peripheral bond buying. I'm not sure how that's going to work, to be honest. So I would even view that one as initially positive and then probably turning back down, because the effect would be relatively zero. And psychologically taken as it would be to help in a panic situation. So that's basically my view. I don't have a position right now. I'm still long the euro sterling, because I think we also technically have broken a very good level. But euro dollar, it's really an open question. I think we need to move back above what is it, 105 and a quarter or so to start to be neutral, but let's see about that later.
Yeah. So, you know, this is a big event going on. It is a big market risk, potentially big market risk at the moment, while this meeting is ongoing and until we potentially hear the outcome from it. So, you know, we can talk all day about the possible ramifications and what they might do, what they might not do. For trading it or for looking to trade it, we've got to understand that this is a risk event right now as we sit here. So, you know, if you're in positions, you need to be careful that you've got your positions managed, lock in any profits if you can, make sure your stops are set relevant. levels, so that if there is a big move, you don't get caught on the wrong side. We know this event is happening. There's no reason to be caught out massively if there's an errant headline that blows your positions. And all we can do really is sit and wait to see what happens, see what comes. I'm not looking to trade the euro right now. Like Kay, and as most of you know, I'm in long euro sterling positions, so I'm just managing those at the moment. You know, we're talking about the euro dollar. It really, really hasn't had that big a move over all this meeting news and what's going on, which tends to also suggest that the market may be not ready to take anything really to heart on this, or it's not pricing any huge risk on here. But perhaps we're seeing a little bit of volatility, and the market is waiting to see what it gets before it does make a move. The fact we have pinged up above 105 shows that a level I was looking at as a big level, big historical level. The fact it cracked fairly easily, but it was headline driven, could mean that the egg's been cracked here. We're back below, obviously, on the fact that the rumours that it's just going to be about the PEP is being taken negatively, but we don't know what we're going to get. So the risk is really twofold here, and I'm not inclined to get involved in that. I'll sit on my hands and wait to see what comes from this meeting. Now, I haven't really looked at many headlines. I've had a brief run through. There's not a lot going on. Obviously, the big news today is going to be, or the big event outside of the ECB is going to be the Fed. So we're going to take a look at that quickly. As we've been saying all week, the market is getting really bullish over this. Let's just show you this. So here's a list of all the big banks and what their calls are. And as you can see there, pretty much 75 BPs is the shout from a lot of the market there, a lot of the banks. So as we've been saying, we need to look at where the market is leaning going into this, and the market is leaning in very hawkish, which brings the big price risk towards disappointment. It's going to be a big evening tonight. We're going to get the headline drop around 7 p.m. London time, 1800 GMT. That's when we'll get the initial rate decision, what they're going to do, plus a few lines in the statement. Similar to the ECB, will they get a price move there, depending on what comes out? Then we might get a little pause. Then we might get the market waiting for the press conference before it then makes its secondary move or follow through move, depending obviously what comes out of that. So really what we're looking at here is what's going to be hawkish, what's going to be less hawkish, what's going to be super hawkish. Now, given that the market is largely expecting 75 basis points, if they deliver on that, really that's going to appease the market. So in price terms, the upside in yields and the dollar may be a bit limited to just the initial reaction, the confirmation of that. Then we need to look at obviously the statement. Does this mean that these 50 pip hikes they've been promising is now turned into 75 pip hikes? So we're going to get a series of 75 pips. Is it a one-off? Are they looking at more? Are they looking at 100 pip hikes? Depending on that sort of scale will depend on how hawkish this is going to be, and thus the big price moves. So if I have to take a scenario, 75 pip hike, and then they say the rest are going to be 50 pips, well, that's going to still be on the hawkish side, but the market's saying this is potentially a one-off, then they're going to go back onto their previous path. If they leave the door open, if they go 75 and leave the door open for more 75s, that then puts it into a more hawkish realm, which is more bullish for yields and the dollar. Obviously, go super hawkish if they do something silly like 100 BP hike and then promise to continue doing, to coin a phrase, whatever it takes to contain inflation. That'll be at the real hawkish end, and that'll see the market blow out. Looking at the other side, if they just go 50 pips now and stick to their current path that they've told us about, that is going to be seen fairly negatively. Not huge. I'm not talking about any collapse in prices or anything like that, but we will see a decent correction. It still keeps them on the hike path, but it's given the market a kick up. the arse to say you're getting too far ahead of yourselves here. This is what we're doing. This is the path we're on. This is what we're sticking to. And then the eraser and Tipex will come out on all those little bank numbers you can see on the screen there, and they'll all be revising them down for the next meeting. That is the way of bank analysts and forecasts. Now, I don't really see a scenario where they say anything that's really less than hawkish or unhawkish. And I mean, my view is that they do go 50 pips tonight and they stick with their path. One of the things they have to consider is financial stability. You know, they want a soft landing, or Powell wants a soft landing for these hikes, wants a soft landing for the economy. Suddenly going from a 50 pip path to 75 pips or more doesn't create soft landing conditions. It creates crash conditions, because then you're going to be hitting mortgages even harder. You're going to be hitting borrowing. You're going to be hitting corporate debt. There's lots of fallout that comes from going too hard and too fast in hikes. And I think that's what they're going to be concentrating on, more so than last Friday's CPI print, which a lot of the market is banking these hikes on. You know, as I said to someone yesterday, you know, if they hike 75 pips because Friday's CPI was 8.6%, what happens if next month's comes in at 7% or 7.5%? Are they going to then do the meeting after that at 25 pips? You know, central banks don't work like that. They don't work on one number, one data point. They like to set a path, let the market know this is what we're doing, leave the door open for adjusting that path, but they're not really into shock tactics and jumping around with their possible rate moves. So that's my overall feeling for the Fed. Kay, do you want to add anything to that?
Yeah. Okay. My two cents are really open. They really could do 75 BPs, not only due to the CPI, but that CPI might have pushed them over the edge to front load rate hikes. And really, a lot can be said tonight, in my opinion. There's not one, two possibilities. Of course, there's only two possibilities, let's say, in the actual hikes. But what they will be saying, there's loads of possibilities this time, in my opinion. Powell could continue to walk his fine line, which he actually walked relatively okay. It's only the last week or two that stocks or equity markets are really starting to suffer. But I really think I'm pretty convinced about that they are watching the S&P level at 3,400, which was the level where we stopped pre-pandemic. And there's another one, a big one around 3,200, which is my do or die line for the S&P if we get there. Oh, actually, that's good that you've put it up. So I really think they are watching it, and they are watching it as a benchmark to see if markets are holding up, yes or no. Is the last week or two relatively fast drop going to alarm them and keep them on their 50 BP path, or is it really going to spur them to do 75 front load and then signal a kind of going back to basics? That is also possible, and the market might have like a small downward reaction on the 75 BPs, although a lot of people expect now the 75 BPs, but could see a very nice jump on the back of Powell announcing some sort of returning to a more gradual path. So the possibilities are really legion for me. It's all going to be about the wording. I think we've got the outlook as well, right? Today we've got the projections and stuff. We will see how about how much the Fed members think that they need to hike more. So it's going to be a meeting which, perhaps more than taking a decisive direction, is going to be very volatile, in my opinion.
Yeah, you're absolutely right. We do have the policy projections, which are doing as well as the ECB forecasters. I think they were in the last projections, they were forecasting core CPI at 4.7%, at 4.4%, and CPI at 4.7%. We obviously know that's complete rubbish, because at the moment it's running at 8.6% for CPI and 6%, I think, for the core. So they're well above. So the forecast are going to be doing also some TIPEXing on their prior forecast, and that will feed into, as Kay says, what the Fed members think about rates and stuff. So obviously we're going to be looking at the dot plot, how high all the dots move up, where they see, or where we get an idea of this neutral rate, or where at least rates, the majority of the members see rates settling in the years ahead. As we mentioned, we already get in the market pricing in or starting to look at rate cuts from next year. So are we going to see that also in the dot plot? That there's lots of permutations that can happen tonight. And really, for all the talking we do, and obviously we hope that the analysis helps. Talking this out with Kay and the other guys in the chat room certainly helps me get an idea, at least of a few possible scenarios that might happen, and from that you can gauge potentially what prices might do, what the dollar might do, what the euro might do, so on and so forth. But we can spend 2 hours talking about what they might do. At the end of the day, we all have to sit there, watch the screen, watch the lines pop up, and react to it. And so that's exactly what I'm going to be doing trading wise. Is going to be reacting to what we see in the headlines. So if we look at something like dollar yen, what's happening here at the moment? We've had a break up into 135. It's looks like it's running off again. Here we have a double risk for this pair, because we've obviously got the Bank of Japan on Friday. So what opportunities might we grab from that? If you think that the Fed is going to only hike 50 basis points, if you think they're going to stay on their path, and the market gets disappointed at that, dollar yen is likely to tumble. Now, is that a dip you want to fade or get onto to run into the Bank of Japan? If you think that the Bank of Japan are going to stand their ground, stick to their easing policy, not announce any form of looking at tightening, and we see a dip on the Fed here, say to 133, and in the Bank of Japan on Friday, and it runs up to 137. These are the little sort of opportunities you've got to weigh up, taking one event and matching it off against the next event. So for something like dollar yen on the Fed, is a dip disappointing? Is a dip in this pair disappointing? No. I mean, if you look at the technicals that we've been pointing out for the last few days, we're looking at the potential range here. We've had this break now of 135. So again, the egg's been cracked. The trend up is continuing. I still want to see perhaps what happens if we get a test of 133. That's the sort of level I'll be looking at if we get sort of less than really hawkish news from the Fed. If we get down there, what's the price going to do? If it breaks straight through on a first hit, I'm not going to be interested. I'm going to sit back, sit on my hands, see what happens. But again, it's looking at what the price has to do if it's going to make a real move. And so if it's going to do something, it has to break 133. If it doesn't break 133, if it finds it as support, well, then I've got potential opportunity to try along, keep it fairly tight, and see what happens. Does it stay back? Does it go back in a range, or then does the market come around to them pricing the Bank of Japan? But it's also worth noting the Bank of Japan is a binary risk as well. So if you feel like fading a dip in dollar yen to run into the BOJ, you've got to be prepared that if they do say something hawkish, this is going to get double spanked. So there's lots of ways to skin a cat, but for the most part, I'm going to be taking the details of what comes out from the Fed, taking the headlines from the presser before making my decision. Do I think this is going to move the price significantly? Do I think it's going to stay in range? So what you want to do as traders, what I do as traders is just running into the event, and I'll usually do this maybe a couple of hours before. I just pour over the charts and I look at all the levels that I've got in play, both above and below, and I'll decide what levels am I really interested in. For example, I'll look at this trend line that I've got here. Yeah, I've got it marked as a visual aid to show how the trend's going on. Am I going to trade it? No. Will it come into consideration over the Fed? Absolutely not. So I discount that level. 133, that's going to be one of the levels I look at. And if we break there, well, where can we go from there? And as I say, I'll pour over the charts. I may put some levels in, and what I do is I plot the levels, then I look at them and think, right, which ones am I really going to have some strong conviction of? And those are the ones that I'll watch, and everything in between I'll largely ignore. And from that, you can potentially find yourself stretch points. You know, if you do get a big move, it's going to stop somewhere. You just try and plot where you think it might stop, where the text show that it may stop because there was prior action there. And you wait and see if that happens. And if that happens, and if you find tops and bottoms being made or found, that's when you start to think, okay, now I've got some levels to trade. Because if you just trade around in the middle, you know, you trade on the initial announcement, fine if you're scalping and you grab a move. But if you're looking for something a little bit longer to run a bit longer, you've got to watch out for the risk that the statement may say something and Powell may say something completely different in the presser, and we get a lot of volatility and your positions get shaken about. Kay, you looking at trading anything particular for this one?
In dollar yen, no, I don't think I'm going to trade much.
And also that goes out to you guys and girls in the room. Have you got any trades that you're looking at? Let us know.
No, I don't think I'm going to trade much in dollar yen based on the Fed, but I might trade a few extremes or try to put on something in the yen for in case Bank of Japan announces something. I think there's a lot of pressure on the Bank of Japan building up over the past weeks. Kishida, Prime Minister Kishida, actually just came out to say that monetary policy can affect currencies. Yes, okay, kicking in an open door, but it's the fact that he says it, not the fact what he says, is the fact that he mentions it. I think it's pretty important. He says he expects Bank of Japan to continue efforts to meet price target. Okay, but I think the pressure is building up so much that Bank of Japan might be close to do something. What it's going to be, most of the board are doves, yeah, over there. So I doubt it's going to be a life-changing monetary policy change, but being Japan and having been for so long blocked into this negative rates and YCC, it might come as a little bit of a shock. And we can't also forget that the market is very short yen. There's been a lot of yen being sold over the past months, and the market is very short yen. Would it only be momentum funds, model funds, the Japanese whales, a lot of people are short yen, so we should not forget that. If in turn Bank of Japan says nothing, this thing is, I don't know, it could be 115 there, right, in the dollar yen. But based on the Fed, I would rather look at stuff like euro dollar or cable or something like the commodity currencies than yen at this point for myself. Yeah,
definitely. Just looking here, so Hugo, he's looking at to go long SPOOs after the FOMC. Give us your reasoning for that, Hugo. Do you think they're going to be less hawkish than expected, and that's going to be a boom for stocks, or how do you visualize that? I mentioned this on Face yesterday. I don't know what the Fed means for stocks right now. I think stocks are in a completely different world to what they were before. They're making the adjustment from, you know, QE support to, as I've said, standing on their own 2 feet. It means different dynamics for stocks right now. So are stocks now going to be following what the economy does more closely than, you know, if the economy tanked, they knew QE was there to bail them out. QE is not there anymore. So what happens to the fundamentals that drive stocks? Are they going to be following the economy? Do they trust that the Fed is going to, you know, fix or fight the inflation problem sufficiently, create a soft landing where the economy doesn't tank too much? If that's the feeling, then stocks go up, in my opinion. If they think differently, they think that the Fed's going too hard on hikes, it's going to create a crash rather than a soft landing. In my opinion, that's going to be negative for stocks. But I'm not 100%. You know, my I call it, I won't call it expert view, but you know, I've been doing this a long time. My view is that stocks are transitioning from the QE period to, you know, what I would call more normal times that we haven't seen for 15, 20 years. So that's what I would view stocks in terms of that. Am I right? Am I wrong? I don't know. What I will learn is what the price does. So if I'm right, then, and the market thinks that it's a soft landing coming and the Fed's doing all right and stocks rise, then I'll tick the box and think, right, okay, well, that is what's happening. And from that point, I can then decide how I want to trade it. I know that good economic news is good for stocks, bad economic news is bad for stocks. And from then, I've potentially got a bias. And vice versa on the flip side. You know, if the market thinks that the Fed is going to do well, but stocks tank, that suggests perhaps QT is still a big issue. And there are other drivers in stock markets that are not following the line, if you like. So it's all about discovering what the price wants to do, discovering what markets want to do. But you know, if that's your idea, Hugo, if that's what you want to do, you know, you let the price levels tell you what's what. And if you're going to trade that way, if you're going to trade your view, just make sure you know your risk, you got your stops in play, and if you're wrong, you acknowledge that you're wrong, and you don't lose more than what you wanted to risk by being wrong. And that's all we can do as traders at the end of the day. Jack, he's looking at some of the commodity currencies, pound Aussie, pound Kiwi, Euro Aussie, that sort of thing. Kay, do you want to have a quick look at a couple of those? Got anything on your radar for any of those currencies? I know we don't tend to look at the pound Aussie, pound Kiwi that much.
No, well, those crosses I'm not going to look at really into FOMC unless they are driven by risk factors. So yeah, just to follow up on what Hugo said on the S&P, I think we have a good level to monitor. At least if stocks would start to rebound, it's the viability above 38.5, call it 38, 40, 50-ish. If we start to tackle that one and stay above after the FOMC, that would be a positive for stocks. But therefore, the first condition is that they only do 50 and not 75. If they do 75, I think if we see a knee-jerk reaction that the market says, okay, we've got it, now they're going to pause, or the market thinks that they might pause or so, we might go up to 38, 40, 50, but I would suspect that is going to cap then over there. So on what Jack was saying, what is it? Sterling Aussie, sterling Kiwi, Euro Aussie, Euro Kiwi. Okay. Right.
I mean, the one we're looking at is looking at quite a lot at the moment is the Euro CAD.
Yeah.
You know, don't want to repeat the same old stuff. You know, looking at the support level down here. Yeah, I mean, the commodity currencies it's probably not something I watch a lot over something like the Fed.
Well,
it's all dollar centric that we're looking at.
I would do personally to watch Aussie dollar and Kiwi dollar over the Fed, but it is true that some of those pairs like Euro Aussie, if you look at for instance the Euro Aussie, Euro Kiwi, have been going up during this latest week and a half. That's a very good risk barometer. You can actually trade them off stocks if you'd wish so. Because there's usually when risk comes off, the euro, the low yielders tend to gain versus commodity currencies, because the commodities will come under a bit of pressure as well, same as with the stock market. So that tends to gain. To go long, let me grab the screen. I can.
Yeah, go ahead, mate. Let me knock it out. Hang on.
Where's my stuff here?
All yours, mate.
Yeah, share screen. Where's my screen? Here it is. Share. Okay. Need the chat open.
Yeah, got it, mate.
Yeah, okay. So this Euro Aussie here, I think we've broken through this longer term trend line, which we tried a few times. We came back to test it, and from 149.60 it took off. There's a smaller one around 150.5, and also a smaller trend line which has already three or 4 points now, which comes in there as well around 150.5. I think that's a good level to watch, to see if this holds or not. It could be a nice trade down there to try long again, to see if we can get up to the 152s that we were trading before the last leg lower. So that is one. On the Euro Kiwi, what do we have? Well, you see my Euro Kiwi screen, it's empty. I haven't been trading it for ages. Let's see if I've got, no, I really, but let's do a quick one here. That's one leg. That's another one. And we are right there now on the Euro Kiwi. We are at an important level here, 168.40. If it goes, this could be trading up to 169.80 pretty quickly. And the support there should be around 166 3/4 90. We also have a trend line coming up there, which has been holding, and then this is the top of the pattern, I'd say. So we are right around there. So keep an eye on that one. If risk falters further, this could shoot up a little bit. But everything, of course, a condition under the condition to what ECB is going to say today. They could really put the cat amongst the pigeons if they do anything harder than just talk about the PEP. I'm going to let me just move over to what's going on in the metal sphere ahead of the FOMC. So we've broken through this trend line. We've tried, as I was saying the other days, we tried 1875.80 on gold, capped, went down, back through the trend line, back through the smaller trend line, back to the below the 200 DMA. It's this 40-50 zone is now going to be starting to build a big resistance, in my opinion. It's going to need a dovish Fed with higher inflation to take this one through this level decisively again, in my opinion. Until then, I'd say 1800, 1835 looks like a decent sandbox to play in for a while, and see what happens if it breaks out of either side after the FOMC. Silver, the same. We tried a little long with Stelios the other day, and of this 21, and it was a nice little rally. And now we're here again on this first resistance level, which is around 21. That's 49, 21 and a half. It's silver. So we need to give a little bit of leeway to the levels, although the lower end of the support there has held really well. This support around 2089. So we have our little range in play. Call it 2090, 21 to 21 and a half. If after the Fed we could move through this level, we are going to have to reckon again with that 22 figure 15, in my opinion. This is going to be again a big play, a big resistance area up to 2230 again. But if we manage to get above and hold, this looks nice to me for a return to to 22s eventually. If in turn this starts to break below 2089.90, I wouldn't be surprised if we have a look at this lower end of the 20 bucks. There's not a lot here, so this is going to be a very important support if it breaks lower around the 2044. I think if that goes, then we talk about 19s. On the rest, sorry. I was yesterday I was showing in the room this important level on the dollar mix. We're still in a downwards channel. We ran up to the mid 60s that I was talking about, but to me the important one lies here around 2080. And if we get a knee-jerk reaction higher, but based on really a short-term one in after the Fed on emerging markets, this one could come into play, and I might give it a try short over there. I was in overnight with an order, but I pulled it now ahead of the Fed. But I'm very interested in this zone here around 2080. It's also, of course, it's emerging market. You have to adapt, and that's always what I do. I adapt my amounts when I trade emerging market currencies. I can do something in dollar yen, I can do something in euro, dollar, cable, whatever. But in the emerging market currencies, I will always or usually trade slower unless it really holds my levels, and then I can start to add. But initiating emerging markets is always going to be slower than call them the G7 or the G11 currencies. So this one is really interesting. if in turn we start to trade and we warrant a move back below 40.43, this whole move up may be kind of done, and we might be looking again at the 20 figure, in my opinion. So I'm still overall, unless the Fed goes uber hawkish, overall relatively more confident trading this from the short end than the long end right now. So
cool, mate.
The other one, dollar rand, as I was saying, still this major zone around 16.30, 33, 32, 36. If it goes back below 15.80, 87, 86, 87, that might be the end of that move, and we could see it back lower. But again, overall, my view on the FOMC is really, I honestly think they can do 75. But it will depend on what power, which line Powell is going to take into the presser, or which line the Fed members will have pushed him into, and I think a lot will depend on that, on the presser. Over.
Yeah. Cool, mate. So I think, when we do a lot of the analysis you see here and the prices and stuff, a lot of it can be fairly repetitive. We look at the same levels, day after day after day, and I don't want you guys and girls to think we're just being repetitive. A big part of trading is sitting and picking your levels and then waiting for them to come along, waiting to trade them. You keep an eye on the situation. The thing with trading is you can watch levels for days, weeks, months. But when the price moves to it, you have to assess on that particular day what's the driver. So you can watch a level for months and think, right, well, this is happening because a central bank has just decided to hike 100 pips, and you think, well, I don't want to trade the level now because this news is huge. It's going to change the trend in the particular currency, and suddenly a level you've been watching for weeks, you don't want to trade. But for the purposes of what we do here on the show, a lot of what we show, we're going to be repeating, time after time, because until we get a price move to the level or a break, we've got nothing else to talk about. And we, as traders, we just want to wait for those levels. And, case in point is here in euro sterling. I know Gavin asked about this. I had this blue band here. I had it a bit tighter. I had it sort of 60, 70. But I was, as I say, poring over my charts yesterday, and it was a bit wider, starting around about the 45s to 70. Obviously the big break that we had was off the 86 level. As we know, been talking about it forever. Kay got in with a buy stop at 86.10. I didn't go with a buy stop in the end, but I waited and watched. We had the pop higher. I think it got to 15 or something. Then we got the test back down of the 86 level, and I got in at 86.02. You know, just a way to try and save a few pips to see if it holds. And by and large, the level held. You know, we've got it pretty 86, 85, 95 odd. That's what I look for. I look for this break here. We got the break, had a little pop, then it ran out of steam, but we held. That's the confirmation. And so I got in 86.02, cut on the way up. I cut into this level because this is one of the areas that I've been looking at. As you can see, we had a little bit of resistance there, a little bit of a pause. Then we moved through. Then we had a break back under, found a bit of resistance there. You know, then a bit of flip-flopping. Now we've had the break on again. Take it a bit further. We've gone through 87. Ran into the next big line of resistance that I've had on my chart for a long while. You know, this is what you have to do when you're looking at trades, when you're looking at technical analysis. What do you do when you get to these levels? I know I keep repeating it, but I can't help it because this is how I trade. And you know, that's how Kay trades. This is how everyone should trade. You look at what's standing in your way of making more profit. And I was a bit fortunate. I woke up this morning just as it was making another high, and I cut some of my core longs and some of the 86 trade around about 87.10. You know, and now I can see what goes on. What's going to happen from here? Well, we come back down to this zone again. You know, it's a bit of a wide zone, so that means to me I don't know where it's going to stop. Is it going to stop at 70, 65, 55, 45? Where? I don't know. So what I do is I look at this as a zone. If it stays above the zone, we can push on up. If we don't stay above the zone, if we come back below, that potentially means this zone is going to become a resistance point again. Are we going to see further downside? So, you know, now we're marking, you know, 3-4 attempts at this area up here. Obviously, a lot of this has been driven by the ECB stuff. So again, I'm a bit neutral here because I don't know what the announcement is from the ECB. You know, the ECB could send this back down to below 86. Conversely, they could send it way up above this 87, 15, 20 area. So right now, I'm just watching, sitting, waiting and watching. But back to the technical points, you know, this is why we got our levels. This is why we pick them. Sometimes you have to wait for them. Sometimes you have to wait days, months, you know, whatever for them. You know, if we do break, oh, that's kind of a bit wiggly. There we go. If we do break higher, what's the next level? The next level for me isn't up until 88, and then we get into the 61.8 fib of this move from 92s. Break that, we're on for the 90s. I know Still's been going on about the 90s for quite a while, but yeah, you know, if we do break up here, 88 into 88 is another level that I'll be looking to maybe take some profit, start to bring my stops up behind it, lock in what I've got, put some money in the bank, see what it does here. Just play the price action. Cable, bit of a wild ride on this one. Big psychological and technical level down at 120. A lot of us in the room had a little scalp off that level yesterday. I managed to grab a few pips out of it up to the bounces to the 30s. Then I brought my trailing stop up behind it, kept it below my entry, so I gave a little bit back. But you know, we're back above now, so we've had the messing around down there. It's starting to be support again today. Just looking at the daily there. Again, have a look at the 15 minutes, which is one of my favoured time frames for watching the price action. You know, there we had the support, there we had the bounce, then we had the break. That was the flush out. Back above, now it's support again, now it's support again. There were potentially barriers down there. I didn't hear anything concrete on those, but the way it was trading, you know, around this sort of area suggests that there may have been barriers down there, but it is a big fat round number, big psychological number, which also makes it as much of a target as it does a possible level where people were sitting bids on. So we've had the flush out. What do I want to do with cable from here? Not a lot, really. It's still very messy. I still struggle to find reasons to buy it, on at least on a fundamental basis. Everything's pointing negative for the UK. Obviously, we've got the BOE tomorrow, so perhaps this move we're seeing today is a little bit of a straightener. The market's now thinking, right, we've had our fun down here at 120. All the people who are short into that are now closing up with the BOE risk in mind. Where it can go from here is anyone's guess. The Bank of England could go hard on hikes, and we're back up over 122, 123 in a flash. They could be more or less hawkish, and boom, 120's gone, and we're trading 118, 117. Who knows? It's not one I'm really getting involved in. Only reason I traded it yesterday was just as a big figure trade. Kay, you got anything on the pound? I know you was in there as well.
Yeah, I tried to. And I managed to get roughly to break even. And then we had this, while I was out, this late flush out down to 119.30s. If I saw that correctly, that was a bit of a weird one. But then, yeah, the bounce came as quickly. I'm looking at the first point of measurement, I think will be around 121.51, 55.65 in the cable post FOMC today. Well, you know my opinion about the sterling and the sterling correlation with Bailey. As long as Bailey is governor of the Bank of England, you won't see me too long sterling for very long. I think he has the power to mess up even a strong currency. So I'd be looking, I think, ahead and into the BOE. I'd be looking to sell into rallies, but will it be an FOMC rally or a Bank of England rally? That'll be kind of decisive for me. If it's purely at the FOMC, I would watch the 121.55.65 top side. If it's Bank of England in combination with the FOMC tonight, we might have to widen our horizon up to 122.80, 123.10, something like that. And I would say it's all possible. Look at the volatility that we have in the market. Look at the vols in the option markets. Those moves are now possible, where we for months, years have had to trade 20, 30 points, and a 50 points move was large. Those vols are now possible. The two big figures, we have seen it. The cable lost 5% over a week's time, right? So yeah, those vols are all possible now. So make sure to have those white levels in mind as well, not only what's 20, 30 pips away from current market. So I will be watching that. I will be watching that, and on the bottom side, I will be watching the 119.90 figure again, and probably the 119.60, which was the prior low, right? Not yesterday's dump low or panic low. I will be watching this 119.60 as well. And on the sterling, that's about it. I'm pretty confident still with my euro sterling, because I think the tech break was decent, as well as the directional fundamental break. I've also offloaded stuff as in we put in our trade rooms. I managed to kick some out at 87.15 as well this morning, so that's all welcome. I'm back to, let's call it a core position, because I was long before the break, so I added on the break of 86 yesterday. So now I'm back relatively to core. Let's put the break at is relatively taken, and I'm back to core, and I'm sitting here waiting what to happen. I think low 86 is I'll reload again with a close eye on 85 to start with if we get down there, and that's cool. It for me.
Cool, mate. Well, just quickly, want to get a couple of things out the way. Just looking at the vols, as Kay mentioned, we look at this the other day. I look at the 1 month at the money vols, just gives you an idea of how volatile things are. I think beginning of the week we looked at this. Dollar yen was 13%. That was, I think, 10%, something like that, just 10, 11%. Euro dollar was under 10%, 9 point something, if I recall. Now we're up at nearly 15 for dollar yen, nearly 13 for sterling, and over 10 for the euro dollar. So you can see that volatility is picking up. That means when you get these headlines, when you get moves at the moment, they're going to be larger. Your 10, 15 pips of last week is probably 30, 40 pips this week. So just bear that in mind. Obviously, a lot of the volatility is around this ECB meeting and the Bank of the Fed and the Bank of England. So there's some natural extra volatility in there, but just this is a good gauge for me to see, you know, how volatile things are getting. I'm keeping an eye on the clock. I know I've been keeping you a long while. Just a couple other things to take a note of. Oil's obviously has ramped up again. You know, it's staying a bit bullish. We're off a bit from still off a bit from the up at the 124s, but we're still looking pretty solid up here. Given that effect is not really playing into the CAD, it seems to be off the oil bus slightly. Maybe it's got half a foot on. We are back up in this big technical zone that I've had on this chart for quite a while. One I have looked to short in before. I had mixed success. I tried shorting it, then I tried second guessing myself and doing some money there. This is another one potentially I'm going to be looking at if we get up but can't break 131. This is a bit of a line in the sand for me. If we get above there, if we break that, and then potentially, you know, the final mark is going to be this trend line 131, 45, 50 maybe. That's an area. If we do break this 131 and break that, then we've potentially got another big move on our hands, and we're going to get a run up probably to the 50 fib of that big move from 2020. Conversely, this is the sort of area, the sort of levels that I'm going to be looking at, these highs, if we can't break those over the Fed. If the news is hawkish but we can't break these levels, maybe I'm going to be looking at scaling in a few shorts and seeing what happens from there. Yeah, so that's it. I don't want to keep you guys and girls for too long. We're going to be glued to the radio, to the wireless for what happens with the ECB. Let's see what comes from that. Please trade safe over these events. Keep yourself safe over the Fed, the FOMC, Bank of England, Bank of Japan, all the rest of them that are getting thrown at us. Maybe next week we'll have a little bit of a quiet one and we can talk about some other subjects. But in the meantime, as I say, please stay safe. Please protect your accounts. I hope you make tons of pips, and we shall see you tomorrow for the aftermath. Good luck, folks.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.